Hello, good afternoon and welcome to MF Corner on CNBC TV18. I'm Vinnii Motiwala. Thank you so much for tuning in as always. Now today we're going to be putting the spotlight on pure international funds and hybrid funds, the offering that is there that comes in from international funds and hybrid funds. Why this topic? Because there are some hybrid funds that have international exposure as well. Now, does it make sense to invest just in hybrid funds? Should you invest in international funds as well? How should you go about it? What gives you better returns? What is best suited for you as an investor? To discuss all of this, we have Sanchita Mukherji, Senior Business Economist, Mutual Fund Distributor and Managing Partner at Talk the Walk. Sanchita, good afternoon. Thank you so much for joining us on the show. I want to just start by talking about the key differences that we have between a pure international equity fund as well as hybrid funds, right, that have global exposure, especially in terms of risk and return profiles for an investor. How should you be looking at both these?
Excellent question as always, Vinnii, and such a pleasure to be on your show. This is very, very pertinent in today's date when we are actually facing a lot of geopolitical upheavals, geopolitical tensions. So there's obviously a lot of curiosity in terms of how does one approach international funds versus hybrid funds which do have an exposure to, say, a particular international stocks or ETFs. Now, what do we mean by international funds? First of all, international funds are like pure equity diversified funds, which are structured as a fund of fund, and that invests into another fund, any one particular fund with respect to a particular region, like a US, Canada, China, Japan, etc., or an ETF of that particular country. So that's a pure play of an international equity fund. A hybrid fund, which does invest into international equities, in India currently it's structured as a multi-asset fund. So certain multi-asset funds have to diversify across, say, domestic equity, domestic debt, say commodities, international equities being a part of the diversification in a multi-asset fund. Now, the fundamental difference between the two is one is an international pure equity, 100% equity exposure without a comfort or a cushion to fall back with any other asset class. Whereas an aggressive hybrid, a lot of these multi-asset which invest into international equities have a cushion of an Indian debt, fixed income component, rate, and domestic equities play as well to diversify. And the risk-return aspect, of course, becomes very different because in an international equity fund, since it's 100% equity, the risk, it's a high risk. Right. Whereas for an aggressive hybrid, it's moderate to low high because then you have that comfort of the debt component as well.
Mm-hmm. Absolutely. Sanchita, thank you so much for explaining us the details and the difference that actually comes in between these two, right? But are hybrid funds then in India actually, do they allocate enough in international assets maybe to get that exposure and that concern, right? Like you started off saying, there is so much uncertainty around that everyone wants that global exposure as well. Or is it enough? Or maybe you still need more diversification on the international side if you have one of these multi-asset funds then?
Wonderful question again. So this purely depends on the profile of the individual investor and how sophisticated they are, what is their risk appetite, and how their portfolio is being managed. For example, a very high risk-taking individual who's also sophisticated and understands the nuances of international investing would say, hey, why don't I use this volatility as a friend? Why don't I use this geopolitical uncertainty as a friend and diversify my portfolio across different geographies? For example, the layman rule, which is typically the standard rule within a mutual fund industry, is to have a 10% diversification, say, into international funds. So now that could be done in terms of structuring your portfolio like international funds, domestic equity, fixed income, commodities, or one can look at a multi-asset, which gives a much, much smoother journey without taking all of that kind of volatility into account, but The drawback being the returns will not be significantly higher if there is a kickstart to a certain geography. One can invest accordingly if you're a low to moderate to low high kind of an investor. But coming back to the risk appetite, when one invests purely in an international equity fund, we have to be very mindful that there's a huge currency play also at work. So apart from understanding geographies, apart from understanding the equity valuations of that particular country and economy, one has to be very mindful that you are also investing into the currency of that country. For example, when you have international exposure, a stronger rupee can actually eat into your returns, whereas a weaker rupee can aid your returns. So the moot question is, would you now be looking at investing across currencies or using the multi-asset to smoothen out the curve and smoothen out the journey? Because let's understand, in an aggressive hybrid fund or a multi-asset fund, the fund manager's acumen also comes into play because they use a lot of in-house domestic modeling to switch from debt to equity. Whenever there's an opportunity in an international equity, they do take that. Whenever they feel that the going is not so good, they allocate more into debt. So that gives a much, much smoother kind of a ride. So that's point number one. Point number two, one also has to be mindful of the TER, which is the total expense ratio. For example, in an international equity fund, you have the expense ratio of the fund of fund, plus you have the expense ratio of the fund that they're investing in abroad, in some other geography, or the ETF, right? So that might be a double whammy. So what is the total expense ratio vis-a-vis aggressive hybrid, which will give you that kicker of an international equity exposure, but at the same time, lesser volatility, more rebalancing with a domestic cushion, and possibly lesser TER.
Okay. Sanchita, then what should I pick if someone has to pick right now? Should it be hybrid funds or, the multi-asset allocated funds, or should it be international funds right now?
Well, to be honest, I am not regulated to give a direct investment advice. So I honestly cannot speak on advice on what fund to pick at this point in time. It'll purely go by the investor's own asset allocation and, like I said, individual risk profile. However, what I can say is, out of my 23 years of experience in the Indian mutual fund industry, aggressive hybrids, multi-asset funds give an excellent smoothened journey over long periods of time.
Absolutely. How should one actually start evaluating, right, the performance if I'm starting to pick up? And I'm seeing that there is some exposure of these multi-asset allocation funds in the global portion as well, which they've invested. It's going to be the feeder funds, ETFs, however they've invested. So how should one evaluate the performance? And how should one be wary of the downside risk that could come in maybe when I'm investing in that multi-asset allocation fund?
Yes, absolutely. It'll all depend on the underlying fund being invested in. When you're investing in a multi-asset as well, you have to be very mindful in terms of what the multi-asset actually means. Is it domestic equity? Is it domestic debt? Is it international fund exposure? And if it is an international fund exposure, it is going into which underlying fund or which underlying ETF or which geography it pertains to. Is it a commodity play? So all of this, one has to be very mindful. For an investor, they need to understand when they're specifically investing into high risk and sophisticated funds like this, they should definitely go through the SID, which is the scheme information document. That will actually give you a very clear picture of what the fund can do and can't do in terms of allocation to which international fund. And secondly, portfolio disclosures. When you go through a monthly report of portfolio disclosures, you will have a complete knowledge of the breakdown when you're deep diving into which sectors, which stocks, even within the international fund. You know what that fund would be having, what the ETF would be having in terms of stock selection. That would be useful for the investor.
Sanchita, for investors with the risk appetite, we've spoken about that as well, right? Everyone will have a different risk appetite. How much allocation should actually come into international hybrid funds? What is the optimal one as of now, maybe to get one of those best returns? And should they go for maybe SIPs, STPs, lump sum? What would be the best strategy?
Good question. Here, I would always look at it this way, that you have as an investor and as your own risk appetite as an investor, because investing, let's understand, it's never a pure science. It's not one size fits all ever. So what your neighbor is doing is not something that you would be doing, right? Because you're a totally different and an independent investor with your own individual style, individual risk appetite, individual objective, time horizon, all of that. Let's understand these kind of things also are very contingent to the time horizon. So hence, if one were to look at the situation today, given that uncertainty definitely is a watchword, I think looking at a pure play as a lump sum or going into a tranche is a very, very risky strategy. One should definitely be looking at an STP or an SIP for entry, and one could look at these allocations. Definitely, why not? You should ideally make use of volatility as your friend, and one can use this strategy to be a satellite strategy to your core portfolio. It need not be an integral part. If it's an integral part of your portfolio, one can look at it in 5 to 10% broadly speaking, given that the other 90%, again, you would have benchmarks in terms of multi-cap, flexi-cap, momentum fund, index investing, all of that is there, debt portion as well. So within keeping all of those parameters in mind, one could look at a 5 to 10% allocation and definitely through an STP SIP route.
Okay, Sanchita, thank you so much for giving us those details over there, and who can look at it, what should be my allocation there as well, looking at the point of view of multi-asset allocation funds who have international exposure as well as international funds, how one should go about it. But Sanchita, do wait by with us. We're going to take a very short break. And after the break, viewers, actually, we're going to be discussing some more details in terms of thematic funds, especially coming on the digital India side, right? When you have so much coming in on the tech front, new age tech, what should you be looking at? And momentum funds, where do they stand? That's all what we'll be discussing after this break. Welcome back to MF Corner on CNBC TV18. We still have with us Sanchita Mukherji, Senior Business Economist, Mutual Fund Distributor and Managing Partner at Talk the Walk. Now we're going to be putting the spotlight on some sort of thematic funds. I especially want to talk about the IT side of funds. There is so much coming in terms of new tech funds as well. New companies are coming in, new age tech, fintech companies. And how does that stand with momentum funds? Because they invest on the base of the momentum that's going on. Sanchita, let's start by talking about just basics. Thematic funds, how do they differ in terms of style-driven momentum funds? In terms of investor investing also, how should that portfolio construction work? Because everyone wants good returns, but which is the right time to look at what is something we don't understand. So how should we go about that?
Yes, interesting. And it is definitely for a very, very sophisticated investor, let me put it this way. Thematic IT fund, the giveaway is from the word itself. So SEBI has done a wonderful job of the nomenclature, because the nomenclature is easy to understand and relate to. So a thematic IT fund would invest into the IT universe, the tech universe, which is the digital India universe, right? So that is the sector. It does not invest, it will not take an investment into anything else. So that's a thematic IT fund. A momentum fund, for example, would be slightly different. So momentum fund only invests into sectors where they see a price momentum or an earnings momentum. So that necessarily does not have to be IT. It can be IT, pharma, capital goods, etc. So they will see their only qualifying criteria, again, as the name suggests, would be the price momentum, the trend momentum, or a earnings momentum. That's what they will be investing in. Now, when you come specifically to stocks, again, a thematic IT fund will look at new age companies, IT, fintechs, all of that, but within the technology space, and they would look at growth, they would look at vision, they would look at a lot of fundamental attributes, right? In terms of how they're doing in the technology space, what is their market share, what is the story, all of that. Now, for a momentum fund, they would again purely be driven by the price momentum and the earnings momentum more than fundamentals. Right? Again, now when we're talking about, say, churn, in a thematic IT fund, which will be spread over a longer horizon, they would look at the fundamental growth story in terms of who are the industry disruptors? Is there a long-term future disruption which is coming into play over here? They would invest looking at that. So the concentration and will be across the IT sector within India, the digital India, and the churn will not be that high. It will be moderate. But in a momentum fund, they are, because they only captured the price momentum and the trend, right? So the churn would be higher. It can be even as high as monthly or quarterly, because they will drop out the IT companies or the new age IT companies which are not showing a price momentum or which are not showing an earning momentum, and they will bring in newer leaders. So that's a rule book that one can follow to understand these two different categories.
Sanchita, I just want to understand a bit more. So, suppose there's a time when there is momentum funds, right? So that is depending on the move, like you spoke about it as well. So then what happens if I have a momentum fund? At that point of time, you're seeing momentum coming into this digital IT names right now, which are trending, right? Fintech or new age tech companies. While what if I'm invested in one of the funds or sector thematic fund, which is specifically IT? Then how do I play around with my portfolio that time?
Again, it's all depends on how you plan to design your portfolio. For example, momentum funds typically actually work in most portfolios in an out and out bull run, right? In a market which is sideways, it's very, very difficult to predict how a momentum will play out in terms of you might not be able to get a particular momentum in a particular sector or kind of a theme, right? So it's very, very difficult. And momentum funds typically do not play out well in a range bound market which is going through a price correction or a time correction. Whereas in thematic IT, one can look at it in the sense that, right, there is a lot of upheaval which is happening in the sector. There is a lot of news flow which is happening, all of that. But at the same time, a thematic IT fund looks at investing across legacy IT names, large caps, as well as new age IT companies, right? Where a lot of action is happening, where a lot of traction is coming in terms of even price momentum, right? So there you have kind of best of both worlds if you're looking at a thematic IT play. So one would have to actually see whether you would like to be in an all-out momentum fund, which is a trend setter, and maybe bet on a certain trend that, hey, I think the markets might have a certain momentum in the near future, and let me add momentum funds to my portfolio. Or maybe you really, really believe in IT as a story, and you see that the valuations are very compelling for you. And you decide that, no, let me have a thematic IT fund because right now I think it's a lot of blood on the street where IT is concerned. So let me have a 10-year horizon and add maybe a thematic IT to my portfolio, and I'll keep it for 5, 7, 10 years, given that the valuations are very compelling. Because see, another difference between thematic IT and momentum, let me tell you, is the valuation concern. Yeah. Momentum will invest at any valuation, right? If they see a price momentum happening, they will go for it. Right now, active momentum funds also do try and keep a quality check in terms of the valuation to address the valuation concern. In fact, they look at the balance sheet a bit and the debt ratios, the return ratios. However, momentum funds rarely look at valuation concerns. That's a pure price momentum that they play on. Whereas thematic, one needs to be very convinced. If you see that there's a conviction and you feel that you can hold on to IT for a longer horizon and you're wishing to play that, valuations can be very compelling because then you can enter cheap.
Right, Sanchita. Now I just want to focus a bit more in terms of the IT sector thematic funds, which we have. We have so many options, right? And the new age tech IT also. There are funds which have started investing in those smaller mid-cap IT companies or even fintech companies. How should investors actually assess now? Because you want returns, you want valuation, you want growth also. How do you assess between these options? Some of them are legacy, some of them are new businesses. As an investor, what should you do and how should you judge this?
Very easy. Leave it to the fund manager with a consistent track record and a style of investing. See, because it's very, very difficult for a new investor to understand pure stock play within the sector. Think about it, fund manager with the expertise, with a team of probably 60 analysts or 20 analysts or things like that. I mean, the kind of understanding that they would have in terms of deep diving into every company, understanding the price to earning ratio, their order book, how much of it is traditional business, how much of it is new age business. Nowadays, they're even looking at peg ratios that, okay, let me not even buy cheap, let me buy reasonably priced because I'm convinced as a fund manager that there is a future growth potential. All of this is all bordering actually on the fund manager's own wisdom, knowledge, analyst team, and the way the fund is managed. So for a retail investor, for any investor to deep dive, particularly into any particular stock, is very, very difficult in today's date. Ideally, one should invest with stable, diversified IT funds, which have a proven and a consistent track record. One could look at the fund's own Sharpe ratio, the Turner ratio, to understand how the fund would perform.
Okay, that's interesting there. And leave it to the fund manager, but a lot of ratios that you can keep an eye on also when you're judging it. Sanchita, thank you so much for joining us today on the show and giving us an insight in terms of, whether momentum funds, IT funds, what we should be looking at over there. Thank you so much for joining us. And viewers, thank you so much for tuning in as always. Don't go anywhere. Our sort of trade is still there, so you have closing bell up next.